So, I mean, so it is a really a big thank you to Rashmin Bhai for having, coordinated this program, and who are followers on international taxation, who like the policy, will be in for a treat. Government, etc., we would never have been able to be as well placed as we are today. Today, even the sabzi wala or the bhaji wala is happy extent. I mean, things have become digitized. I think globally we are operating in a digitized environment, and therefore, of course, whilst it is very good news for a lot of us, it also does pose challenges for tax jurisdictions, because there's always been a turf war in terms of jurisdictions when people enter into international transactions and there are cross-border transactions. There's a turf war between the developed countries and the developing countries. There's always been a turf war between countries of residence and countries of source. And I think this will always continue. But I think overall, uh, as you know, there has always been a framework or trying a consensus building that is sought to be achieved. And this is exactly what international community was looking at trying and getting a long-term solution which would be simplistic, which would not pain people and would not impede trade flows, and at the same time try and ensure that all countries who are a part of the transaction equally would benefit. That is easier steps. As you know, one of the digitized economy paper was something which was most looked forward to by most people. And I think that is where there was a kind of a consensus that there would be a two-pillar approach agreement in order to thrash out this particular issue, which is a very vexed issue. That discussion was started last year. There were comments which were invited by the OECD, and finally, on the 1st of July, we now have some kind of a statement on a two-pillar solution to address the challenges which have been posed by this particular situation on the digitalized economy. In that background and context, to discuss this very, very important issue in relation to digitalized taxation, because as you know, India also has been very proactive and has acted swiftly in the past, because we have been one of the largest users in relation to e-commerce transactions, and legitimately India would want to tax a certain percentage of these transactions for the benefit of the Indian economy, which has actually contributed to the income generating potential of some of these players as such. And therefore, we have had an equalization levy, and in the recent past, also the concept of a significant economic presence. And while we did that, as you know, the government had mentioned that the equalization levy was a temporary measure till such time that a consensus was built, and then we would move on to what would be the permanent long-term measure that was being suggested by the inclusive framework and the OECD and other international community as such. So we have, as I mentioned, a galaxy of experts today, and it was my pleasure to introduce the experts. We first have Mr. Rashmi Ranjan Das, who again is very, very well versed on matters of policy, tax policy, and tax formulation. He has more than 30 years of experience and service, and is presently posted as the Joint Secretary FTTR in the Ministry of Finance. He is currently, Mr. Rashmi Ranjan Das functions as the competent authority of India for tax negotiation, tax treaty negotiation, exchange of information, etc. And he represents India in the entire G20 and BEPS inclusive framework discussions. And that's why it is very important. His presence here is very important for us, because he can give us at least a clue on what were the kind of discussions in relation to the July 1st statement. I think we have all agreed that we will look into the background of how the July 1st statement came in. Discussions are still on, and I think towards October we are looking at a framework, but I don't think we will be looking at that. We'll be looking at the historic framework, and I have requested all the stalwarts to at least help our people get an easy understanding of what is being looked at and what is being thought, because this still a lot of this is under work in progress as such. Mr. Das has a postgraduate degree in public policy and management from the IIM Bangalore, and is also a postgraduate in international relations from JNU. So you will all agree excellent person to be having here today on this forum. And it's a pleasure to, sir, have you on the panel. Please welcome. Thank you. We then have Mr. Rajat Bansal, Chief Commissioner of Income Tax. Yesterday, we were all excited to see that Mr. Bansal is now also an additional charge of the Principal Chief Commissioner of Income Tax. And, sir, thank you and congratulations, first of all, for that. He has been India's competent authority again for 6 years, has negotiated some very, very important tax treaties. And I think of particular significance to the members of the audience is that Mr. Rajat Bansal is the member of the UN Tax Committee, which has been involved in addressing the tax challenges of the digitized economy, the topic which we are looking at today. Also very important, and where I think we had the pleasure of having Mr. Rajat Bansal, I think last year or the year before, was to talk about Article 12B, where we had addressed members of the ICAI, and he is the architect, as we know, of that Article 12B, which may find a place in the UN Tax Model Convention. So extremely very valuable insights that Mr. Bansal can also provide to us on what is the thinking on this subject. So again, a great pleasure to have you, sir, on our panel. We then move on to Mr. Akhilesh Ranjan. Akhilesh Ranjan is no stranger to all of you. I think a very fine officer, and I think I have been also had the pleasure of interaction, Mr. Bansal. It has always been, of Mr. Ranjan, and it has always been a pleasure to deal with Mr. Akhilesh Ranjan. He was the member of the CBDT and was a part of the entire tax policy and legislation and tax policy formulation. If I could, though this is a platform, if I could actually really reveal what I would want to wish from the heart, I wished he would have been the CBDT chairman, and that's a personal wish that I have always had, because I have seen him on the platform of the IFA in overseas conferences, and the way Mr. Akhilesh Ranjan was respected, and the kind of the balance that he brought out in the chair, as in spite of being on such a high position, was something that we all admired in Mr. Ranjan. And I think, Mr. Ranjan, you really brought a lot of respect and to the chair that you had adorned. Now, of course, Mr. Ranjan is in his avatar of being on the other side of the fence, as being advising another of the big four. But welcome, Mr. Akhilesh Ranjan, to the program, and it will be always a pleasure to have you here, sir. We finally then have, last but not the least, Mr. Rashmin Sanghvi, a chartered accountant, and all of us in Mumbai know Rashmin Sanghvi, extremely simple individual, but he has been a guru to a lot of us because he has always been preaching principles of tax as well as FEMA. His classes in FEMA, his classes in the lectures on FEMA and tax have always been something that chartered accountants in Mumbai would always respect. And I think one thing that we all admire about Rashmin Bhai was that he's always been a contrarian. So while most tax practitioners would always like to attack the revenue and defend a position of the taxpayer, Mr. Rashmin Sanghvi would be extremely balanced and would always try and point out why it was important for India to tax a particular provision. I've been on several panels with Rashmin Bhai, and I think we were on the opposite side of the fence where I was trying to defend the Vodafone ruling. And Rashmin Bhai would say that the Vodafone ruling in the Bombay High Court was, I think, the more correct one, and things like that. So whether you agree with your views or don't agree with the views of Mr. Rashmin Sanghvi, one thing is always there, that he always looked at the big picture, and he would always be free and frank to express an opinion on the matter. And I think it is all credit to him that we have the panel discussion here today, because he has assembled this galaxy of experts and felt that it was very important to have a discussion on this very important topic in relation to taxation of digitized economy. So Rashmin Bhai, thank you so much. So this is essentially our panel. We will have finally our vote of thanks and closing remarks by Mr. S.P. Singh, again, who's a stalwart on international tax policy and formulation. We are lucky to have Mr. S.P. Singh today with us. And as an advisor to the Committee on International Taxation, and I can take a little credit for that decision. And having with Mr. S.P. Singh with us now, we have seen that the International Tax Committee has got a complete fillip in relation to the dissemination of information on host of topics that we have for our members. And I think, as you all know, there's an important role of ICAI, that is we are a partner on nation building as well, and therefore it is always our endeavor to represent a very balanced view, to take the views and represent our views of the taxpayers to tax officials and to revenue officials, and also at the same time represent what is the correct view and encourage our taxpayers to pay their fair share of taxes. I won't say too much because I would leave you to the hands of a much more eminent audience, but I can only say one thing. You know, I'm a cricket fan, and I can say that the galaxy of experts, the three experts we have, reminds me that this is like a gathering where we have a Rashmi Ranjan Das in the form of a Virat Kohli, Mr. Rachin. We always argue who's the better of them on the current day, whether it was Mr. Gavaskar or Mr. Tendulkar, but you have all the three before you today, and it is your pick. So thank you for, again, Rashmi Bhai, for assembling such a galaxy of experts. And with that, I hand it over to you.
Good afternoon, friends. Many thanks, Mr. Nankishore Hegde, and thank you, Mr. S.P. Singh. We have the opportunity for discussing a few views on digital taxation. Today's conference is a very unique conference, and I'll tell you why. Because as of course Mr. Hegde has explained, we have got the three stalwarts, all of whom are architects in digital taxation. Of course, they have contributed many other things, but on digital taxation, these three are the most important architects for the law. That is first uniqueness. The second point I will say is that while we have called it a panel discussion, there will be no debate and no arguments. And the reason for that is Mr. Rashmi Ranjan Das will not argue with Mr. Rajat Bansal and Mr. Akhilesh Ranjan. Mr. Rajat Bansal will not argue with Mr. Akhilesh Ranjan. Mr. Akhilesh Ranjan being the senior most, he can of course comment on everything. And I am being a simple taxpayer. I have no adhikari. I am not adhikari. So I can raise my queries on everybody. So the point is, all four of us will present our views, and it is for you participants to take a decision what is just and fair or what is better. We will not be offering any conclusion. We will just make our presentation. Here I will take 1 minute to point out one Indian philosophical principle of Anekantvad. Anekantvad, in short, says when there are 5 individuals, especially 5 intelligent individuals, there is all the probability that there will be 6 views. And we are assuming that all of the panelists are honest. They are all talking in the interest of India as a whole. And even more important, we are all talking of what is just and fair. Now, something which is just and fair will be just for USA also, for India also, for all the countries. Now, this is our attempt. Now, even then, even though we all of us have the same target, we can have different views. And the Anekantvad principle says this is normal. This is the natural thing. So one should not feel anguish about somebody expressing a contrary view. So now we have all these panelists. The another important thing or unique thing about this is that OECD has been trying to work upon digital tax rules for last 24 years. Now what is so important about digital taxation that somebody like OECD takes 24 years? Why? Now, I am trying to explain you in next 18 minutes what is the key issue behind this. And Mr. Hegde has told me that some of the participants may not know the intricacies of digital taxation. In fact, a few may be not even aware of international tax issues. So my first focus is explaining the key issue. See, when we are talking of domestic taxation, we do not even think of jurisdiction to tax. But that is a fundamental issue, and we should all remember that Vodafone was asked to pay 11,000 crores of rupees tax, and Vodafone succeeded in not paying that tax on the issue of jurisdiction. Then there were so many other arguments, but jurisdiction, section 1, section 5, 6, these are so important sections which once we pass chartered accountancy exams, we forget about them. And our practice goes on business, income, salary, capital gains and all that. But today we are talking of these fundamental provisions. And under international tax or double tax treaty jargon, there is a country of residence, which means the SAC is resident in that country. And under the accepted mode of double tax avoidance agreements, the COR has a right to levy the tax on the global income of the SAC. Then there is country of source. If the SAC has a permanent establishment in another country other than the COR, then the host country is treated as country of source. In case of dividend, interest, etc., also there will be a country of source from where the income is accruing. Now these two, ultimately the whole treaty framework is for sharing the tax base between these two, COR and COS. The tax base will be allocated through the treaty. Thereafter, the domestic law will work. What rate to be levied, how to compute income, everything will be under the domestic law. In Latin American countries, Brazil, Mexico, etc., they had been raising the issue that COR gets an unjustly very small share of tax base, and hence COS gets a very small base of taxation, and COR gets the maximum rate. Now this tussle between COR and COS was never recognized in India. We did not bother about it because we never went into those details. Now why? Because when the first treaty models were drafted, India was nobody. India was a British colony and we had no voice anywhere in the global atmosphere, global tax work. Okay. Forget about 1947, we became independent, but I would submit that even till 1992, very few individuals in India had good knowledge of international taxation. That would include chartered accountants, it will include tax officers and whoever would be interested in international taxation. The knowledge did not exist in India. All the battle was only whether it is royalty or FTS and whether the rate should be 30% or 20%, things like that. Okay. Now, how do you allocate the tax base between COR and COS? The fundamental principle is the country which contributes to the business and contributes to the profit from the business should have a taxing right. So, for example, if there is a business between a UK resident and an Indian resident, then France has no right to tax it. It is only between UK and India that the tax base will be shared. Okay. I am focusing only on the relevant issues for digital taxation. So, if we go to Article 7, Article 7 says the business income shall be taxed only in the COR, except when there is a permanent establishment. Okay, so if a permanent establishment is there, then the profits attributable to the PE can be taxed by the COS or the host country. Okay, now what is a PE? That is the issue where the whole thing started. Now, these treaty models were drafted about more than 100 years back. That time nobody had imagined about computers, internet, this vast mobile telephone network and all those. Satellite was not even thought about. Okay. So the idea was that P can be said to be existing in a country where the SAC has a fixed place of doing business. And this idea stuck because, in law, once an idea is accepted, it is most difficult to challenge that idea. And it was the Indian High-Powered Committee on E-Commerce where the PE concept was for the first time challenged. But that is a matter of separate history. Okay, so 100 years the PE concept was going on. In the year 1997, OECD realized that now, that time they used to call it electronic commerce. So OECD realized electronic commerce is going to be a very big business and the existing rules of taxation may require modification. That was in 1997. We took up the issue in 1998, OECD published the Ottawa report. In 99, India accepted the issue that yes, electronic commerce is very important, and the committee was appointed by Finance Ministry to look into the issue. We looked at the issue and we said that the concept of permanent establishment cannot be applied to e-commerce. For the non-e-commerce or physical commerce, it is okay. Permanent establishment is okay. For e-commerce, we have to develop a new concept. OECD rejected the idea. Now, India is when it comes to international matters, we are a very responsible country. We do not take unilateral steps unless the community of nations agrees upon it. So having published the e-commerce committee report, India did not take any further steps to tax electronic commerce. Now see how the nature works. OECD rejected it, but the e-commerce business expanded so much that it became very important. Even by the year 2012, it was important. And the British government and the French government realized that as a COR, all the tax base was going to USA. And while Google and Facebook had massive businesses in Britain and France, they were not able to tax at all. Hence, mainly at the instance of these countries, the BEPS group was formed with the main idea that electronic commerce tax must be worked out. Then they changed the name from electronic commerce to digital commerce. The expectation was that in 2014, the rules for digital taxation will be drafted and published. Till 2021, the rules have not been finalized. 1997, OECD started working on it. 2021, we are still debating about it. What is the reason? I'm asking a question for every participant to ponder about it. Can there be a business without market? Can there be contribution to profits without market? The business will not exist. So, country of market also contributes to the business and also contributes to the net profit. Then why country of market should not have a right to tax? This country of market concept was totally ignored right from the beginning, and there is a whole history about it, which I have explained in my other articles and my book on digital taxation. I'll not go into detail about it, but countries of market were totally ignored in the system of tax-based allocation. Okay. Now, when UK and France realized that they must have taxing rights, the debate on digital taxation started. Now, for all practical purposes, if we go by the concept of materiality, USA is the only country of residence when it comes to digital taxation. Any modification of the existing rules means countries of market will get some right to tax at the cost of USA. US government's tax revenue will be reduced and other countries will get the benefit. Now, how am I making such a serious statement? Mr. Robert Stack was the team leader at BEPS from USA. He retired in the year 2017, and at that time, in an interview with media, he made this statement that USA had decided that this BEPS Action 1 task force should not be able to publish a report until the year 2020. And he took credit that he succeeded in fulfilling that target. Friends, what I am discussing here is, we chartered accountants have a weakness. When we read a law, even a draft law, we straight away jump at interpretation of law. we don't look at the process which goes behind drafting of the law. And in the process, supposing it is just within India, then there are intelligent people arguing, drafting, redrafting, editing. But when it becomes a global issue, there are nations which are, you know, I will not give adjectives, but there are nations who want the whole cake. They don't want to share the cake at all. Then there are other nations who either succumb to that pressure, and there are very few nations like India who will fight for their right. And India has been most active. I mean, probably in our history, independent history, after 2013, India has become far more pragmatic and contributor to the drafting of double tax avoidance treaties. And I think we must all congratulate these three stalwarts who are with us in this panel discussion. All three of them, of course, there are other people also, but a whole team from the CBDT has contributed to BEPS action report and a lot to treaty drafting. Now, coming to another aspect, this is no longer a legal issue. At BEPS, I'm submitting my view that they are not talking of tax principles, legal principles. This is a tax war. If you are aware of the concept of economic war, currency war, this is a tax war. How do I call it tax war? Now remember when France proposed to levy digital taxation, President Trump declared a trade war on France. He declared a trade war on the whole of European Union. Any nation who even dared to utter that they will, because OECD was not able to come out with any solution, so British government came out with its own proposed law of diverted profits tax. In fact, they legislated it. Australia had a proposal, France had a proposal, European Union was debating for long on digital taxation. But Mr. Trump threatened everybody. And everybody was terrorized, because if USA threatens you, who will not be terrorized? Now this is a fact of life, which a chartered accountant or a lawyer, when he sits down and interprets equalization levy and finds out 11 mistakes in equalization levy, he does not look at the process which went on drafting behind the digital equalization. This is the main point which I wanted to bring out. Anyway, so Mr. Trump went and Mr. Biden is there now, the president. Under him, the USTR threatened all the nations with sanctions, economic sanctions. If you talk of digital tax outside the OECD platform, then you will be punished. And India was invited to present its case. We were guilty before USTR and we had to defend our case. Now, just think of the international atmosphere, which is to a right-thinking democratic person, this is unacceptable. But the whole world went to USTR making representations. Finally, on 1st July, we have got a proposal, and that proposal I would present before you a very small PPT, just to, you can compare the whole thing. I'm sorry, the software asked for some steps for taken. Mukta or from ICAI, this is asking for some password for me to share. Can you please give me authority to share the PPT?
हेलो सर, पासवर्ड नहीं चाहिए. प्लीज शेयर अगेन सर.
Yeah.
Can I share, sir? If you not able to.
Yeah, if you can share, that will be even better.
Just one second, sir.
That's okay, he's sharing. Thank you. Okay, while the slide comes up, I will just tell you, I have assumed here, I am just presenting an illustration before you. I have assumed that there is a non-resident corporation which is selling goods to India. Now remember that under OECD proposal, the ring fencing has been removed. In other words, the proposal will be applicable to digital services, non-digital services, physical goods, everything. So, in fact, right now we are working on a client's matter. Okay, he is importing a ship from abroad, and we are examining whether the provisions of ACP and equalization levy would be applicable to a ship or not. Now, imagine the situation. Because everybody drafts the law to make it applicable to all and sundry. Everything should be covered under the net. Now, that is another side of the law drafting. So today we are in a situation where you forget about digital taxation, anything else can also become subject to tax. That is the language. Of course, that is not the intention of the law, but the language needs to be improved. Okay, can you go to the next slide, please? Yeah. So here I have assumed this is a non-resident corporation, not necessarily digital. It has a revenue of 1 lakh. 1 lakh may be anything. It may be 1 lakh multiplied by 1,000. It may be dollar, pound, rupee, anything. Out of that, let us say that company earns Indian revenue of 5,000. Then it has declared a profit of 15%. Now, friends, understand the importance of the word declared. Okay. What the OECD says is that the SSE will declare his consolidated profit and loss account. It will be an audited profit and loss account. And the tax officer of the country of market has no jurisdiction, almost no jurisdiction to investigate into it. I would be so happy if this proposal were there in the Indian Income Tax Act. I have submitted audited accounts to the assessing officer. No further questions to be asked. You please accept my declared profit. Now, one can't imagine that coming into India or probably for that matter in any country, but this is the OECD proposal. Now, this you juxtapose in the light of the fact that the global multinational corporations are known for extremely aggressive tax planning. Call it tax planning or tax avoidance. Now, if somebody does not like my statement, let me remind you that the whole BEPS program started because MNCs were avoiding tax. The BEPS program is not meant for you and me and the middle class people. It was meant for MNCs. Okay. It was meant because MNCs were avoiding the taxation of so many countries. So here are MNCs who are experts in avoiding taxation. And here is an OECD proposal telling us that you don't go into their published account. Okay, so let us say there is a 15% profit the SSE has disclosed. Then the OECD proposal says up to 10% of the profit, country of market shall have no right to tax. Forget about it. Now, in my office with my colleagues, we examined Fortune 500 companies. Okay, Fortune 500 companies, out of them, how many companies will clear several thresholds? First of all, 20 billion euros threshold, then profit about 10%. And out of Fortune 500, there were hardly 60 companies which would cross both the thresholds. Okay, so we go to the next slide. Yeah, so let us assume that assuming you go ahead by the OECD proposal, then 10% of the profit will be ignored. Total profit is 15%, which means 750 of 5,000. We are not talking of 1 lakh. We are talking of Indian revenue. Indian revenue is 5,000. 15% is 750. Surplus over 250. Surplus over 10% is just 250 rupees. Okay. Now I am giving comparison of the Indian Income Tax Act before concepts of ACP and equalization levy were introduced. Now under the old law, since the SSE had no PE in India, there would be no tax in India. And this was the starting point right from 1997 that no PE, no tax is an incorrect statement. We have to do something about the PE. So now then 24 years we have worked, and let us see the comparison in the next slide. Next slide, please. Yeah. Now this is the final slide comparison, because Indian Income Tax Act, let us forget the old law. Under United Nations Article 12B, I must say India is indebted to Mr. Rajat Bansal for bringing about this Article 12B. Of course, others supported him, but this Article 12B played a very important role in the negotiations which are going on at BEPS level. Okay. Now we are assuming the tax base to country of market given is 5,000. Of that, we don't know what would be the rate of tax, because that was left open under the United Nations proposal. But I'm assuming, let us say, if it were the tax flat rate of tax would be 2%, like we impose on royalty, interest, etc., payable to a non-resident. Under royalty, etc., normal tax rate is 10% and above, but here everybody has accepted that the tax rate should be low. So let us say 2% rate. Then the tax payable to Indian government would be 100 rupees in this particular illustration. Okay. Now you look at OECD proposal of 1st July 21. Okay. It says the first 10% of profits are to be ignored. The surplus is 250 rupees. Of 250 rupees, only 30% will be actually the range given is 20 to 30%. Let us say highest range, 30%. Which means India's tax base is 75 rupees. Compare 75 rupees with 5,000 rupees. Okay. Now, of 75, let us assume we levy our Indian tax rate applicable to foreign corporations, that is 43%. India will get 32 rupees in taxation as compared with 100 rupees under United Nations article. If we were to apply the significant economic proposal, ACP proposal, under the Indian Income Tax Act of Section 9, we can go into the calculation, we will get 322 rupees. There is a point here, the attribution of profit needs to be improved, because 322 probably may be too high. If we go under the equalization levy, then this corporation would be subject to about 100 rupees tax. Now, all this slide says is that under the OECD model, countries of market will get hardly anything. But at ICAI, you can please stop the presentation. This is not required now. Thank you. Okay. Now, the issue is not about the amount involved. Amount may be 32 rupees, amount may be 300 rupees. The issue is about the principles. The country of residence getting the largest part of the cake and country of market getting a very small part of the cake, the tax base, is, in my submission, unfair and unjust. But as I have rightly said right in the beginning, all four of us will express our views. You, the participants, take a decision what you consider as just and fair. Before I end the discussion, one very important thing I want to submit, and it is this. For the 100 years of double tax avoidance treaties, country of market was totally ignored. The market was never considered as a connecting factor. With the 1st July proposal, the market is accepted as a connecting factor. So now we have three connecting factors, COR, COS, COM. This is a very significant achievement. All other things aside, this is a significant achievement. This lays down a very important milestone, and from this onward further, I do hope there will be a lot of progress, and eventually there will be a just and fair double tax avoidance system throughout the world. Now, for this important milestone of having accepted market as a connecting factor, I would like to congratulate Mr. Rasmi Ranjan Das, because he has been a very important contributor in this BEPS report. Thank you, friends. With this, I will end my submissions. Institute can please take it forward.
Yeah, Rashmi, why don't you, Rasmin has really laid down the framework very, very lucidly. And we all appreciate, what he said in the beginning, that the panelists will have their own views. The participants may accept, may differ, but yes, he is right in saying that we must appreciate from where is he coming. He has given nice background. I will do all the summing, towards the end, but I would like Rashmi Ranjan Das to share his thoughts when he was putting up the views of India particularly, or developing world in general, before the OECD. Yeah, Rashmi.
Thank you, sir. Thank you, Mr. Hegde and the ICAI for inviting me. And my respect to Ranjan sir and Bansal sir and Mr. Singhvi. I will just have a small presentation because Mr. Hegde had requested me that just to go through the basics of pillar 1, pillar 2 a little bit. And please excuse me in the sense that I will not be able to say anything beyond July 2 because the negotiations are going on, which are in confidence. I am not authorized to say. But I will, as Sir has said, that I will try to see where we reached and why we reached there. I am trying to share my screen. Let me see whether I am able to do that. It is again asking for the email address. Is there a password? Sorry?
No, Gaurav, can you help? Yeah.
Okay, it is now.
We can view it. We can see it, sir.
You can see it. Fine. But
Yeah,
I am seeing my own camera. You are able to see it. No, that's fine. So I don't have to see this.
Yeah, we are able to see it.
We are able to see Rashmi. You have to simply make it full screen.
Okay. I have to make it full
Go
screen.
to below, and then you will see.
Okay, I'll make it full screen. Okay.
Yeah, that's perfect. Perfect.
It's okay?
Perfect.
Thank you. Thank you. I must clarify that the views I expressed here, I'm a government officer, so it's a normal clarification that these are my personal views and may not necessarily represent the views of the government. Now, Mr. Singhvi was referring to that the rules that were framed almost 100 years back. In fact, one scholar had written this, that most stuff from 1920 sits in the museum except the international tax rules. They continue to be in operation even though they are virtually should be in the museum and we should be looking at something new. Now, what is the problem? I think it was being explained by Mr. Singhvi as the slide says, that particularly with digitalization, these problems of international tax rules have become exacerbated and almost it is becoming now irrelevant, if not completely obsolete. And there are two things in the international tax rules. One is, of course, Article 5, all of us were aware, which was referred to by Mr. Rasmin Singhvi. It is a nexus rule. Nexus rule means whom to tax, who is the taxpayer. That requires a physical presence, as all of us know, broadly speaking, under Article 5. Where with digitalization, we know Google, Facebook, or any other, many companies, they do not need a physical presence to operate. So there the nexus rule is failing, so that is a weakness. The second thing, which sometimes do not get as much attention as the first one, and which is in fact for me is more relevant for India than the first one, is that the profit allocation rules, I'm talking of whether it is Article 7 or Article 9, which are based on arm's length principle, it is inappropriate completely otherwise, and it's almost disastrous for business models which are primarily driven by intangibles. Because intangibles have no observable location, as Mr. Singhvi was saying, it's that helps the M&E groups to park profits outside. So this is very important for us because even if you have a taxing right, how much you tax? Let us forget about digitalization for a moment. Let us talk about a phone. All of us use an American company phone. You know that when the phone sells for 100 units in India by a company that company having a physical presence, it collects 100 rupees. Under the ALP, we get only 4 or 5 rupees to tax. That's the income, because on the ground of the functions, assets and risk here, which is basically normal risk-free distribution marketing functions, which means balance 96 or 95 rupees goes back to the parent. And despite the market, as Mr. Rasmir Singh was saying, 100 rupees, under the existing rule, even if the business has a physical presence, we get only 4 rupees to tax. And the entire amount which is attributable to intangible goes back to the resident country or wherever, not necessarily resident country. It doesn't even go to the United States. It may be going to some tax haven. So we don't get any share. And that is, to my mind, is a much major problem for India than the first one, because given the Indian size and the Indian market, there is a limit to which a company can operate digitally. There is a limit to which a company can operate remotely. You can see most of our digital companies, so-called digital companies, most of them operate in India with physical base. But these are the two problems. And the problems have led where, I think again, to account for what Mr. Rasmir Singh was saying, and all of us know, the missing profit report, which was published recently in 2021, it says almost 36% of the profit of M&Es are going to tax havens. I mean, tax haven, some people may not like that phrase. It means a low tax or a no tax jurisdiction. A jurisdiction where maybe the FDI inflow is 150 to 200% of their GDP. Tax rate of Fortune 500 companies is around 11%, effective tax rate. It's worldwide. I mean, the OECD countries are losing around 400 billion, whereas the non-OECD countries are losing around 200 billion every year. And imagine for the non-OECD countries, the corporate tax is a significant portion of their total tax base. Unlike the OECD countries, where the corporate tax base and the personal tax base may be 4 to 5 times their tax base. The latest estimate by the Tax Justice Network says $1 trillion is getting shifted every year. And if we look at even documents filed by the MNEs themselves, next one is from an informal study of the CBCR reports. More than 50% of the MNE profits are booked in jurisdictions where the effective tax rate is less than 10%. And more than 45% tangible assets are located in high tax jurisdictions, naturally to claim depreciation. So the problem, as I was saying, with digitalization, this has been affecting, and this is because of the profit shifting. Nexus is one issue. I think the major issue is profit shifting. I will come to that a little later also. The pre-tax employee ratio in tax havens, the same company in the domestic company operating in tax haven, or even in local firms in the other regular jurisdictions, the pre-tax profits to employee ratio is 30 to 40% in normal tax jurisdiction. But in there, it is close to 1600%. That is the extent of the profit shifting that is happening despite all the BEPS and despite all the anti-avoidance rules that the countries have managed so far. Now, where are we now? What is the journey so far? I think, again, there was a reference for the BEPS 1 report. Actually, the BEPS 1 started with 2008 financial crisis. Countries realized suddenly, because they needed finance, they realized that MNEs are not paying their due share of tax. The BEPS project was launched. India, of course, joined that project. In 2015, the BEPS final reports were published sometime in October. The Action 1 report, which was about addressing the tax challenges posed by the digitalization, that report did identify that there is a problem. That was very clear in the report. And the best thing about that report is that it did say there is a problem with digitalization and the Nexus rules have failed. However, there was no consensus on what is the way forward. And that immediately led to, apart from, of course, I think from the BEPS project, personally, I feel apart from Action 13, Action 4, and maybe of Action 6, if you say, otherwise, not much was up to the country's expectation, and that led to unilateral, people call it unilateral, I call it national tax measures, because all tax measures are essentially unilateral, there are no bilateral taxes. Now, those national tax measures or unilateral measures, because that's the thing everybody speaks about, was taken by Australia, multinational anti-avoidance law, DPT, by US, immediately DPT, but in fact US had the DPT even before the final report came. And here in India, credit goes to Ranjan sir is there and his team. He was the chairman of that committee, and we imposed equalization levy way back in 2016. And Mr. Rasmin Singh was referring to Robert Stack. In fact, I heard him recently saying that we are so surprised that India will take up equalization levy so quickly and will be able to enact it so quickly within months. In fact, that he said that actually propelled the discussion towards having a final solution. And then, as I said, inclusive framework was formed under G20 mandate because the countries were not happy to have a solution. And then these are, I would request those who are interested, these are all published documents and they are exceptionally well written. Now, all said and done with OECD, it has got a very good research capacity and got exceptionally talented individuals who contribute to these papers. The way the OECD churns out papers, sometimes it becomes very difficult for us even to respond. Now, the interim report is published in 2018, which again says there is a problem in nexus and profit allocation. Then in 19, there was policy paper, consultation took place. There is a series of reports, public consultation, blueprints. In 19, Ranjan Sir was there, and from G24, I think I would invite you. It's not public yet, but if you can get, I think it's public now. This G24 is something was started at the time of Ranjan Sir's time. Now it is one of the forum which we are continuously engaging, and we are putting up informally and formally also through G24. We are mobilizing the developing countries, and you did those including the latest one which was sent last Friday, and it led to the final statement on 1st of July, and in between the documents and the public consultation was going on, which resulted in this. Broadly, as somebody has referred to, we have two pillars. Pillar one is about focusing on reallocation of the taxing rights. The problem in, as I said, the Article 5, Article 7 and Article 9, which means nexus and profit allocation. And the pillar 2 focuses on the remaining, I will tax it. This is a secondary taxing right. Now, broadly, pillar 1, I think reference has been made. The threshold is 20 billion, profitability above 10%. The taxable nexus is based on sales only. There is no other requirement for the taxable nexus for the distribution of this additional amount. Sales of 1 million normally, and for 250,000 GDP is less than 40 billion. That is normally for the smaller African countries. And as has been already mentioned, the quantum will be decided, which is between this excess of 10% of the revenue on a purely sales-based allocation key. Of course, there are other things like tax certainty because it's a multilateral measure. No country, there are 179 countries in which, let us say, Amazon operates. Now, if one country says that my amount A will be different, it will affect another 178 countries. So there is necessity to have a multilateral dispute resolution mechanism, which will be manned by tax officials and experts. The implementation is actually the most challenging part of it. It's easy to write a law like this, group basis international taxation. We in India don't have even a group basis taxation in our domestic law, and to have an international group-based taxation is actually something completely novel, never tried earlier, and that's why it will be implementation will be most challenging. However, as far as possible, M&E will be allowed to manage the process through a single entity, through a single return, which will be shared among countries, maybe through a single point of tax payment, which will be again shared by the lead tax administration. As far as possible, the compliance burden should be less, both on the taxpayer as well as the tax administration. And of course, the package includes the digital service taxes and other relevant similar measures will be withdrawn once this mechanism is in place. Pillar 2, broadly, the income inclusion rule. The resident country will have tax if the subsidiary is not taxed properly, the undertaxed payment rule, and the subject is a default rule. I will not go into that. Subject to tax rule is important for us in the sense that whenever some payment is going, whether it's a management fee payment or let us say capital gains or whatever, depending on the scope that is agreed, if the other country has the taxing right and we don't tax, it doesn't tax it, then we'll get to tax that right. So it will stop treaty shopping. the minimum tax rate will be at least 15%, and the IRR, UTPR are common approaches. You are not necessarily required to implement it, but you will honor it if somebody else implements it. STTR becomes a minimum standard. So for the developing countries, countries whose per capita income is below $12,000, which includes India and many, if they ask for with another country, the other country is bound to give that benefit of STTR. That extent is the minimum standard. Now, after the statement was published, Government of India issued a press note which says that it vindicates, as Mr. Singhvi was referring to, the India's principles that India has been fighting for, not for 2, 3 years, 4 years, it's fighting for years together, particularly for the taxing rights for the markets. And I must tell you one thing, what is the change? If you look at the interim report, which was published just 2018, when from India we fought and said that market must have a taxing right and the market must be considered while allocation of taxing right, it was completely rejected. And since we said that otherwise will not be allowed, will not be possible for us to support the interim report that was as late as March 18, we are allowed a footnote. Please look at the interim report published by Inclusive Framework in March 18. It's a footnote says some countries feel that demand side factors also should contribute, should be a factor in allocation of taxing rights. From there, it's definitely a significant journey where in principle sales per se, now there is an allocation of taxing right. There are significant open issues, of course, which again the statement says that share of amount A and scope of STTR. And we said there, and we keep on saying in our statement, and when we manage the G24 statement also, they also be on the basis of our input, we say always same that this package must bring meaningful revenue for emerging and developing countries. Otherwise, it will not be sustainable, even in the medium run, immediate run. Broadly, I think what will be the impact on equalization levy and ACP? Equalization levy, as our equalization levy stands, if a company has a taxable right, automatically it will get out of the equalization levy. And ACP, I think it's more of a policy statement. It is, I don't see any government expected any revenue from ACP per se. Both equalization levy and ACP are more than just revenue raising measures. They are more policy statements and expression of discomfort of Government of India with the existing international tax rules. In terms of quantum, it's negligible. In fact, if you look at the equalization levy collection, with all that what we have done, it even less than 0.1% of the direct tax collection. Less than 0.1%. We are in, sorry, not 0.1.5% maybe. And third thing also we should keep in mind is that we are not in 2000. We are in 2020s. If you look at the CBCI report that is being filed in India, it is quite significant. It's not possible for me to say the actual number, but it compares with many advanced European countries. What it means is, we may not realize, is that we have a huge number of Indian multinationals resident in India. Therefore, we are as much a resident country as much a market. So we need to balance our interest going forward, because this trend is going forward in 10 years, 20 years down the line. We'll have more Indian multinational operating outside, as the indication of the CBCI report now shows. And therefore, we need to balance. We are no longer a country where only source helps us. It's a country now we need to balance our interest as this. Now, before this is my final slide, why do we need Pillar 1 and Pillar 2? Why do we need multilateral solutions? I personally believe the problem is multilateral. Therefore, there is no way to have a bilateral solution in this, because as Mr. Singhvi was referring to, the MNEs shift profits from one place to other. You cannot have a bilateral solution where you can fix them. It is necessary to look at them as one entity. They are actually one entity. And that is why if you look at them one entity, you need a multilateral solution, because all major players have to be together. Signing a bilateral treaty with Nigeria or with even with France or Germany on digital taxation means nothing unless I have a sign with US. Even if I sign with US, all those digital companies may have substantial profits in Ireland, in Bermuda and other countries. If I do not capture all of them, it is not possible. that is why perhaps out of 140 countries in inclusive framework, 133 have supported the pillar 1 and pillar 2, because everybody realizes a bilateral solution will not be a feasible way to go ahead. The second is that if we do not have this, let us say, the counterfactual of not having a solution is pretty, not pretty. I mean, it's very sad. It's more chaotic. There will be multiple and wide variety of national tax measures. We can have equalization levy. Tomorrow, our technology companies operating outside, they will also be imposed some levy on their sales. Imagine a 6% levy on our own technology companies will almost take out entire tax base in India, because 97% of their sales are outside, our top technology companies. We have no sales here, unlike United States, where the US multinational sales is close to 60% in United States. Our multinational, particular technology companies, sales is hardly 2 to 3%, 97% outside. If there is an equalization levy on them, our tax base is zero. And it will also lead to tax wars and trade tensions, inhibiting investment and growth. Mr. Singh, you are referring to the 55 million trade tariff that the US has said they will impose. I don't know what finally they will do. But that doesn't mean that any solution is good. A solution which is suboptimal is worse, because there is nothing worse than a bad solution. And it will not be sustainable even in the medium term. I mean, what will happen is like BEPS 1. Like BEPS 1 came, countries are not happy, there are unilateral measures. There will be another BEPS 2 countries will not be happy, there will be several other things to go away with. So broadly, this is what we are, and let us hope that we get a solution which is reasonably okay. It's more of a political call now, because there is nothing much to argue about on a percentage or on a scope. Technical part, of course, will be done, but hopefully we'll get something which is more inclusive. But I see it this way, that I see pillar 1, pillar 2 not an ending process. It's the beginning of a process, recognition of certain basic principles. I personally feel market now getting recognition will get wider recognition in other normal taxation, normal tax principles. So I look forward to an exciting phase of international taxation, and as professionals, I would request you to stay engaged what is happening. And if you feel anything which is in a public domain coming out, if you have anything to say, we are always open. We are engaging with all the businesses which are likely to be impacted. We are engaging with all the major firms. We have engaged with Institute of Chartered Accountants, other stakeholders. Wherever you feel, you please write to us, give your suggestions, because ultimately it's something that we are doing for the whole country, and FTTR naturally doesn't have the wherewithal to deal with all aspects. So we'll seek your cooperation and your support and your suggestions. Thank you very much.
Sorry, sir. Sir, आपकी voice नहीं आ रही।
Singh sir, आप muted हैं।
Thank you, Rasmi, for really nicely summarizing, various steps which have been taken globally and by India. And we all appreciate, that you must be, and the people from the developing country must be facing real challenge. Starting from no importance being given to the marketing jurisdiction to being heard and something being incorporated. And it's true that pillar 1, pillar 2, all the steps which are being taken are steps in a long journey for getting an equitable solution, because as you rightly said, suboptimal solution is no solution at all, because that may create a bigger problem rather than solving the problem. There are going to be huge challenges, no doubt about it. But the best part is all three of you in one or the other forum have really made huge impact on the development of international taxation. And I do not agree with the initial statement that international taxation is something which should have gone to the museum. You people have really moved it from the museum piece to the actual discussions. Thanks a lot. And then I will move on to next important development which has been happening, and where the contribution by one of us from India is recognized globally, and that is by Rajat, and that is in respect of Article 12B, which is huge step in respect of the digital services. So Rajat, I won't be talking about the content. I leave to you. You can share your experience, the thoughts, and what you see. Will be the fate of the international approach in respect of digital services in the years ahead. Over to you, Rajat.
Thank you, sir. A very warm welcome to all the viewers and participants in this ICAI seminar. And thanks to Rashmin Bhai for organizing this. My very warm greetings to Akhilesh Ranjan sir, SP Singh sir, and Rasmi, besides everybody else. Now, I'll be talking about Article 12B. And let me first, I have prepared a very simple presentation for this to keep it focused. And like Article 12B, the presentation is extremely simple. And the idea is to explain what went into making of Article 12B, why it happened this way, and in what manner United Nations Tax Committee works, because generally we are aware of the OECD work, not so much about the United Nations Tax Committee, how it works. So let me share my presentation. Is it visible?
Yeah, it is visible now. But you will have to, that's perfectly fine, Rajat.
Thank you, sir. Rashmin Bhai was talking about the problem of not assigning weightage to market in international taxation to the country of source. And in that context, he then went on to talk about the digital economy taxation, where the permanent establishment rules were in the way for taxing the income from this particular kind of business activities. Now, Rashmin Bhai and Rasmi have already flagged various aspects, or rather they have laid down the framework under which I can proceed further, and maybe some of it will be repetition. In this slide, I have tried to summarize what are the 4 factors which are relevant for taxing the digital economy, and these will be kind of common in any approach that we are talking about. So first one is whether to tax. So this was the major stumbling block for years, right from the Ottawa framework time to very recently when the inclusive framework solution turned to accepting some kind of change being necessary. Before that, there was always a debate whether there is any reason to tax the profits from digital economy when there is no permanent establishment or no physical presence in that country. Now, in that context, I just want to relate to you an interesting real-life incident which happened with one of my colleagues when she went from Geneva, where United Nations Tax Committee meetings are held, to nearby place called NSC in France by Flixbus, which operates in whole of Europe. Now, she went by Flixbus to visit NSC in the afternoon by paying €2 only. And then she roamed around in NSC, and in the evening she reached the bus stop to purchase while standing in the queue, there was a long queue because many people were wanting to return to Geneva from NSE, and she was standing in the queue. And the counter was showing the price of the ticket, and the ticket price varies, keeps varying. It's not fixed like here in India that it will be only for 10 rupees or whatever amount, but that price was changing, and that was depending on the demand. How many persons are ready to buy and how much space is there in the bus. So depending on that, the price was varying. By the time she reached the top of the queue, the price had increased to 10 euros from 2 euros what she was earlier seeing, and she had to buy a ticket for 10 euros. So this 8 euros was obviously pure profit which accrued or got added to Flixbus profits. And this profit did not come from anywhere else other than from demand. So when Rasmi was referring to demand, importance of demand being recognized in generation of profits in the inclusive framework work, and when Rasmin Bhai was talking about the role of markets in generation of profits, then I just wanted to illustrate through this example that demand is of course a very important factor for generation of profits. Now we have reached a stage where whether to tax is kind of accepted. So that for digital economy, now everyone has accepted that yes, there is a need to change the models, there is a need to change the earlier rules, and that debate has kind of ended, which is a very important achievement for every forum, because this debate was really blocking further progress. And in United Nations Tax Committee, about which I'll be talking just a little while later, this was the major obstacle all along in proposing or coming up with any solution. The next point is what to tax. Now, when we talk about digital economy taxation, whether it would be taxation of services, whether it would be taxation of goods sold through digital platforms or digitally, whether it will be all of them or some of them, and then related issue of ring fencing, which Rasmin Bhai also referred to, whether that, in simple terms, it means that there is an argument that entire economy is digitalized and there is nothing like digital economy separately. So there is no sense in proposing any separate solution for digital activities or digital economies. How to tax? Rasmi explained a multilateral approach that is being adopted by inclusive framework, where the profits of the M&E group as a whole are pooled together and then distributed to various countries where market is there. Other one is traditional approach, in which, like we always have been used to in Article 7, that between two countries, they will decide on the basis of nexus created by the entity facing the source country, and on the basis of transaction between the two, maybe it will use the global profit rate, but otherwise it will be the transaction between the two of them which will determine what amount should be taxed in the country of source. How much to tax? Now, this is a very tricky question because there is no accounts specific to the country of source. So what amount should be taxed is difficult to comprehend, and inclusive framework is talking about a portion of non-routine profits only, whereas in other approach, like in Article 12b, it's the entire profits, believing that profits of a multinational are result of its global activities, and there's nothing like residuary profit or non-routine profit or routine profits that are residing in a particular jurisdiction. Next issue, related issue, is of measurement, because measurement is extremely difficult as to what should be taxed in a particular country. Inclusive framework is talking about 10% plus profits, and 30% to 20% of that is taken as the profits to be allowed to be taxed by the market jurisdiction. Whereas in Article 12b, it is different, which I'll explain. But one thing is certain, that no approach can be exact or measure accurately what profits should be taxed by a by the market jurisdictions. There will have to be approximation here. Any approach you use, approximation is cannot be wished away. Now, this slide, I'll be talking about the United Nations Tax Committee work, because many participants, many of our audience may not be knowing what exactly is the United Nations Tax Committee. United Nations Tax Committee is a committee of 25 members working in their personal capacity, expert capacity. Though they are nominated by governments all over the world, they work in personal capacity and their views are personal views. And it's not an intergovernmental committee. The committee works on a host of issues ranging from everything. Basically, its objective is to enhance international tax cooperation, and therefore it works on various issues ranging from tax treaties, to provide a model for tax treaties to perform the function of norm setting. Then second, in the area of transfer pricing, provide guidance through the United Nations Practical Manual for Developing Countries. There is a handbook on dispute resolution. The committee also worked on environmental taxes. It works on extractive taxation, and ultimately everything is at least said to be in the interest of developing countries. Most of the times, this is always kept in view while in any of the work streams of United Nations Tax Committee, that the output should be in the interest of developing countries. This is very important for the functioning of United Nations Tax Committee. So 2017 to 21, I was a member of the United Nations Tax Committee. The committee allows membership of its members for 4 years at a go. And in 2017, tax challenges of digitized economies was taken up as a work stream by forming a subcommittee. Now, at that time, Inclusive Framework had started was already working on this. So therefore, initially the debate was whether the function of this subcommittee should be just to observe what's going on there so as to not duplicate or do something more. So a lot of time was spent on this debate, whether the committee should do anything independently or not. And then what I was talking about earlier, whether to tax was an open question at that time, and quite a bit of time was spent on whether to tax, and even when some approach was proposed, the question was whether it is principled, whether market being allowed to tax is a principled approach or not. So then in 18th session in April 2019, after a great deal of persuasion, the developing country members were able to convince the committee that we cannot afford to lose time and we have to start working simultaneously rather than wait for the inclusive framework to come up with its own solution. Because by that time, three proposals were already on table in the inclusive framework: the marketing intangible approach, the user participation approach, and the third G24 approach. And after that, the OECD Secretariat had come up with unified approach by combining the three, which essentially was marketing intangible approach. And it was evident to the members of the committee from developing countries that this approach was complex and it was leading to the share of revenue for developing countries which may not be justified or which may not be fair. So on our persistence, the committee agreed to work independently while taking into account the work in the other forums, mainly the inclusive framework. So how will the committee work independently was a question, because every time we sat down to discuss, the matter got stuck in one member contradicting other. So then I proposed that we should allow members to give their proposals, and the independent proposals. A group of members should first form a proposal, put it before the committee, and then the committee should take a call what to do with it. And in 20th session, I made a proposal which has finally resulted in Article 12B, and the majority of members supported working on the basis of that proposal, and we formed a drafting group and the drafting group then polished the proposal and prepared and drafted the entire article and its commentary on its own without any secretariat help. And this was finally approved in October 2020 in 21st session after great deal of activity within the committee and behind the scenes. So that's another story which I have spoken about in many webinars, but that's really something very interesting what goes on in international tax negotiations. And when someone talked about tax wars, then I think that is a very apt description of what goes on when anything is to be changed and when the old rules which should belong to museum are questioned. So that's an interesting story separately. In 22nd session in April 21, which was the last session of this committee's life, text of Article 12B and commentary was finalized and approved. Those of you who have attended that session would probably recall that there was a last-minute attempt also to scuttle the proposal. And, I'm slightly going astray, but I must share with you because it is interesting. One way to postpone any proposal is to say that more work is needed. So whenever I hear that more work is needed, then I understand that this is a step towards its burial slowly. The idea is more work can go on forever and the work will never see the light of the day. So I always become very conscious when I hear more work is needed. So finally, we succeeded in getting this approved, and this article has been approved to be inserted in United Nations Model Tax Convention, and the commentary has also been inserted. So I hope that it will be released very soon, maybe in this month itself or maybe in the month of October, the new edition of the United Nations Model Tax Convention, which will have this entire article and its commentary. I just wanted to also mention specifically that when this article was drafted and when this article was approved, consensus had not been reached in the OECD inclusive framework. Finally, that was G7 statement first and 1st July statement by G20 and inclusive framework when it happened. So sometimes people ask that why Article 12B was worked upon at that time. So let me mention that at that time, no solution had even been reached in the inclusive framework, which I feel even now hasn't been reached fully except a political agreement, which let us see how it turns out finally. Now, as I said, the focus of United Nations Tax Committee approach has been twofold. Firstly, it should be simple. That was the starting point, that the inclusive framework solution is complex, which was the solution being developed in parallel. And the solution should result in reasonable share for market jurisdiction was very important. So this was the second part. Now, Article 12B is a tax treaty solution. What I mean to say here is that taxing rights flow through domestic law, and unless there is a domestic law to tax an item of income, normally there will be no question of it being allowed to tax. Treaties come in the way of overriding the domestic law and not permitting the taxation if there is no permanent establishment. So therefore, there is a need for treaty modification. Just to add to this, because if we can very well draft our own law to tax digital economies as we have in case of equalization levy or in case of significant economic presence. But then the treaty will come in way if the tax is covered by the treaty. We have kept the equalization levy outside the treaty. It is in the Finance Act, not in the Income Tax Act. Otherwise, the treaty will not permit taxation in most of the cases where we have a treaty. So therefore, the fundamental philosophy of United Nations approach, tax committee approach, has been that no one is to tell any country, sovereign country, whether to tax or not the digital economy under its domestic tax law. First, the country should decide on its own whether it wishes to tax the profits from digital economy. And thereafter, modification of treaties is needed to allow the taxation, otherwise treaties will come in the way. And treaties will also permit elimination of double taxation, which otherwise is a problem in most cases, even though domestic laws do eliminate double taxation, but the credit will be possible if other country also agrees to giving credit. Now, what is the benefit of having Article 12B in United Nations Model Tax Convention? United Nations Model Tax Convention, though it is developed by a group of experts or committee of experts, is having a great, is almost equivalent to, or rather I would say equivalent to the OECD model, which is developed by OECD countries, intergovernmental body. And it's respected all over the world. And whenever tax treaty negotiations take place, then United Nations Model Tax Convention is given due weightage by various countries, as I have seen as a competent authority, Ranjan sir has seen as a competent authority, Rasmi has seen as a competent authority. So therefore, insertion in United Nations Model Tax Convention will be the first step in any bilateral tax treaty negotiation to insert it in that particular treaty when it is getting amended or is getting negotiated for the first time. What are the features of Article 12B? Here I have put them in 4 categories. The scope is taxation of automated digital services, which is identical to what it was before this July 1st statement under Pillar 1. The blueprint of Pillar 1 talks about 2 things. One is consumer-facing businesses, and second is automated digital services. So therefore, because automated digital service is directly relating to the digital economy, as we understood all along talking about digital economy taxation, that stream was picked up by the United Nations Model Tax Committee for its scope. Taxation could be 2 ways. First is gross basis. Rashmi Bhai mentioned 2% in his example, but the commentary refers to 3 to 5%. There is a recommendation of 3 to 5%. And 3 to 5 or 4%, if I remember correctly. And so that is on the revenue emanating from the source country. It also gives a net basis taxation option, which is a unique feature of this article, because we felt that if there may be situations where the multinational enterprise is incurring a loss and actually doesn't want to, it's not liable to pay tax in the source country or market jurisdiction. So as an option, it can opt for net basis taxation, and a mechanism has been provided in the article itself by applying the global profitability of the M&E group to the local revenue, taking 30% of that equivalent to something like attribution of profits, and then levying the tax on domestic tax rate applicable to that entity. That will how the tax will be calculated on the profits in this. Then payment basis is an important feature. Unlike user presence, it is payment basis taxation, which is simple and which we found to be most practicable. Interaction with other articles is the 4th feature. Like any other article in the treaty models, what will happen vis-a-vis article let us say 10 or 11 or 12 or other articles, that is taken care of to this by providing in the Article 12B itself. Now, there are certain aspects which I'll just talk about at the end very quickly. The first, I already mentioned that there is no suggestion to tax digital businesses. It is a matter of domestic law exclusively. No interlinking with other issues, standalone basis solution. I mean, we are talking about principles all along, but somehow we have got into negotiations and I would say even politicization of the issues, and we are mixing up issues which are probably not required. And the question is whether the source countries are entitled for this taxation, and the answer is straightforward, yes. So why make it a condition that unless you also agree for something else, I will not allow even this one? So I personally feel that it should, when we allow more issues to be brought into one problem which has been persisting, then we are complicating the issue and making and compromising on the solution that we are looking for in a principled manner for that issue which we started with. Traditional approach for M&E taxation in a decentralized manner. Now this one is very, very important according to me. When we talk about multilateral solution, then why don't we also give up the Article 7 altogether? Why are we only concerned about a particular set of companies to be taxed which are from M&E? There are other M&Es, where there are other M&E businesses. So we will now have two kind of approaches. One is for a particular set of companies to get 87 billion euros or US dollars for the whole world, and the other will be for others. So I don't understand this. If we feel that all multinationals should pay tax by combining their profits, then why single out a few? Pardon me, I forgot to mention that these are all my personal views and in my personal capacity and as a former member of the United Nations Tax Committee, and these are not the views of the government at all. And so this point, according to me, is very important. And according to me, there will be complications when we are pursuing both, and ultimately, we hope that it will be further simplified, but this centralized approach I find extremely cumbersome, and it will be real. Every one of us in the tax world will wait and watch how it turns out to be, because this is a huge departure from what we have been doing. Implementation, bilateral negotiations, multilateral instrument. This is in the context of Article 12B insertion in the treaties. So we will, the issue was whether it will take time to insert it in every article. Of course, as Rasmi said, there is no sense in having it just with Nigeria and not with USA. It will depend. So that's all right. But still, we can take comfort from the fact that fees for technical services article has got inserted in every treaty of India, be it USA, be it Nigeria. Nigeria, we don't have a treaty despite negotiating for 45 years. But be it with other countries, we have agreed with all. And there I will also mention that we will be a residence country tomorrow. But as far as my personal view has been that we should have a principled approach. You will notice that there are treaties of India where we don't have fees for technical services article. And that was the reason behind that was that we felt that we will be exporting to them services and not importing from them. So better not to have it. But as a competent authority, I never ascribed to that view. And even with countries where there was outflow and not inflow, I've mixed up it probably. You understand what I mean to say. My approach was always to have it with everyone, because we cannot be having two sets of rules, one for ourselves and one for others. So I believe very firmly that here we have to be principled. Possible coverage of unilateral measures, equalization levies, and digital service taxes. Now, I have said elsewhere also that Article 12B can easily cover these and subsume these levies within itself by making these levies as covered taxes in the TT. And that could be a very useful way of phasing out these equalization levies and DSTs which are unilateral and for which there is no credit in the other country. I'm saying it in a very simple manner now. It can be worked upon and it can be easily built, a structure can be built in which these levies can be easily subsumed under Article 12B is my belief. And that will be a gradual transition from one present situation of unilateral measures to a system where bilaterally we will be relieving taxes, we will be relieving double taxation as well. So with this, I have come to the end of my presentation. I hope I have not taken more time, SPC sir, than was due to me. Thank you very much.
Rajat, you don't have to apologize for the time factor. You have been so nice that I felt that you should have gone on and on talking about it so lucidly, and it was just like a professor talking to the students who are not so well conversant and making complex things very, very simple. It's really nice presentation, and you have touched almost all the points, starting from the basic concepts of taxation, whether to tax, what to tax, how to tax, how much, and then moving on to the various aspects of Article 12B, the challenges which were faced in the drafting and in the finalization. It has been a very stupendous task and very, very, I think all the developing countries will feel very obliged to you, because until and unless a provision is there in the DTA, even if you incorporate in the domestic law, it's going to a naught. So having this model in the UN model for the tax convention is a very big step. After saying this, we need to listen from somebody who has been in the policy making work, not from 2010, 2015, 16, but right from 2006. Akhilesh, correct me if I'm wrong. I mean, you joined CBDT, I mean, in the policy framing, sometimes in 2005 or 6 in the TPL. So you have been in the thick and thin of the development or the growth of the tax law. Right from then onwards, you have seen how the things have changed. You must have seen how the Indian law has to keep pace with OECD, UN models, and the developments there. So how do you feel? I mean, what would be, we have heard the term just and fair model for the taxation of digital economy. So what do you feel, I mean, should be the characteristics, keeping in mind, I mean, the two models we talked about? Over to you, Akhilesh.
Right. Thank you, sir. Thank you very much. Just to put the record straight, yeah, I joined TPL in 2000, so it was much before the date that you mentioned. So it has been a longer period. Yes, I think some very excellent presentations have been made, bringing out all the relevant issues that are to be considered when you think about digital taxation. And I'm sure that the audience and people who are listening in must have now got a fairly good idea of what are the issues involved, and what's happening, and what are the different approaches that have been taken. So let me just dwell a bit on a much broader angle, and Mr. S.P. Singh mentioned about just and fair taxation. And I think it will be worthwhile to look at these approaches that have been taken in a dispassionate manner, and to see, are we moving forward? Have we moved forward? And where are we, and where do we need to go? I think we, when I say we, not just India, I mean the global community at large. Where does tax policy have to go right now? And that's, I think, a different way of looking at the whole thing. So we have had presentations from Rashmin Bhai, who stressed on the unilateral approach, and he said that this approach is a simple approach which probably gives the maximum benefit to developing countries, and also then takes care of the main concerns of the digital economy. Then we had a discussion on the bilateral approach, which was the UN Article 12B. It took care of some of the problems faced by an unilateral scenario. And again presented a very simple way of arriving at solutions which could be handled within the existing treaty framework without having to enact any other thing. And then we also learned about what's going on in the multilateral approach, and why that approach could be important, and what benefits it would give. But all these approaches are essentially directed at trying to find a solution to a central problem. And that central problem has been brought out very clearly by the earlier presentations, which essentially is the obsolescence or the outdatedness of the entire international tax architecture that has been built and sustained over the last 100 years. This architecture, which rests on the pillars of physical presence in the form of a permanent establishment, physical presence in the form of separate entities to whom income can be allocated on the arm's length principle. These are the entire architecture which has existed, and have probably been formulated by people who are interested in one particular point of view, has been there for such a long time, which has been because businesses were being done. But then things changed when the business models changed, and now with the current business models, again, as has been brought out very clearly, this old architecture has become obsolete. It doesn't provide the adequate answers. The digital taxation or the digital economy is one of the primary manifestations of this problem. The problem is not limited to just digital, it is larger than that. However, it is manifested by this plain issue of digital companies managing to do business in a jurisdiction without having a physical presence. So the concept of physical presence, once it becomes outdated, then the entire superstructure on which the architecture is built collapses. And that's the central problem which all these approaches are trying to resolve. And I think any view that we should take, we should be trying to see as to how best can this problem be resolved, and are we resolving it in any way? So the unilateral approach, as I just said, does help in raising revenues. It does help in taxing certain companies who otherwise may not be taxable to that extent under the normal rules. But then, does it really provide a solution to the problem? It doesn't really change any of the rules of nexus. It doesn't change any of the rules of profit allocation. The two factors which are part of the whole scenario of the international taxation. So it doesn't make any fundamental reform in the principles and the system of taxation. It on the contrary has the potential of expanding in scope. Today we're taxing digital economy on a unilateral basis. Tomorrow we'll start taxing other transactions. We have already done it partially in India. The expanded form of the equalization levy in 2020 goes beyond digital taxation. It goes beyond taxing services, in fact. It starts taxing goods, the sale of goods. And so there is no end to it. There are now, I'm now on the other side from government, and I know what multinationals keep asking is the sense that is it India's intention to tax every multinational on every bit of income that they earn from India in full, not even applying the principles of attribution. So the scope can go so large, so wide, that that there is a danger to the architecture. So on the one hand, it doesn't solve problems, the fundamental problem. On the other hand, it has a risk or a potential of becoming a problem in the future. And therefore, it may not actually provide a very optimal solution. But at the same time, it does establish the fact that market jurisdictions must be entitled to some share of the revenue. The bilateral approach of the UN is an extremely important contribution to international tax, because in all this while the debate going on in the OECD and the unilateral measures being taken by countries, here was an organization of the entire world which is coming up with a solution which says, okay, we will not go into unilateral business. We will avoid the problems of double taxation. We will the simplicity of the proposal, which is something which is all developing countries are aspiring to achieve, that something which is simple, something which is practical, it can be achieved. A wide-ranging support for this proposal from many quarters, from many developing countries, from academicians, from NGOs. There has been a lot of support because of the simplicity, because of the ease with which it can be implemented. But then, does it really again solve the problem? It doesn't create or establish a new nexus. It only implies a nexus. It doesn't change really the profit allocation rules. Please remember, the gross basis taxation or the taxation of under Articles 10, 11, 12, 12A, 12B are all examples of taxation where you try to circumvent the problem of attribution. And instead of going to the PE and the attribution business, you come up with a basis of taxation which is simple and straightforward and apply it on essentially the gross revenue. So again, the fundamental danger of this sort of approach expanding and trying to convert income taxation into a largely gross basis taxation, which I think is again could be viewed as contrary to principles. So benefits on the one hand, but may not really address the central issues on the other hand. The multilateral approach, as Rashmi mentioned, there is no option, as he said, that to a multilateral situation. I would agree that I think all initiatives or any for tax reform must have a multilateral agreement. That's not to say that you couldn't have a multilateral DST. One could have had that. You could have a digital services tax which is multilateral in scope. You build one model and have a system of giving credits. You're solving many of the problems. You could have as Rajat had hinted, you could have an MLI to bring 12B into every tax treaty in the world. So a multilateral solution could be imposed upon that Article 12B also. So the many ways in which a multilateral solution could be arrived at. What has happened and what has been done is the inclusive framework statement which has come out on the 1st of July. There are many views, and we'll have to think whether this multilateral approach then has it really solved problems, has it really addressed the central issues. Well, it has the advantage of being able to address the issues to some extent. It has gone into the question of nexus. It has gone into the question of allocation of profits. It has noted that the existing methods being used to allocate income are not adequate. It has noted the importance of the contribution of markets and demand in generating profits. Those are all issues that make this approach, which has been taken as something which has had concrete results. It has gone some way in addressing the problem. But then again, I mean, the approach is half-hearted. It doesn't go the full course. It creates a nexus, but only for the purpose of taxing some profits. It adopts a formulary apportionment of profits approach, but then retains a sort of a baseline profit, which is said to be a normal arm's length return of 10%. So a mixture of approaches, which is not going one way or the other, which is not really breaking free of the old principles. That's the way in which this solution is coming out. The second question of whether it really helps all countries of the world, is it a solution which can really allocate incomes in a manner which is fair and justable? Well, there are many studies of developing countries, as we have noted, the G24 statement. Developing countries don't seem to think so. There are studies now, very recent study of the IMF, which say that developing countries may not gain at all any significant amount. So it may not be a fair solution, and Rashmi hinted on that when saying that a suboptimal solution would not be a good solution. So I think there is still a large way to go in this particular solution that is being worked out in the inclusive framework. There are many issues apart from this 20% and 30% allocation. There is also the issue of who will give the credit for taxes that are now being paid in market jurisdictions. I think that is a question which, if we try and work out as to whether India will also have to give up some tax, because there are subsidiaries in India or multinational enterprises who are having a higher than 10% or 15% effective tax rate in India. Maybe if the rules are not worked out carefully, India might end up giving up more taxes by giving more credit for taxes paid in other places. So these are all issues which have to be worked out, and I don't envy Rashmi's position at the moment, because I'm sure there must be some hectic discussions going on right now on these issues, not just on the 20% allocation or 30%, but on who gives credit, how does it work out, how do we allocate income. I mean, those are issues which nobody, the public, still is totally unaware of how it's going to happen. How is the MLI going to be drafted? The OECD and Pascal says that it will be ready for signature in 2022. I don't know how he's making that assertion. So, so these are all challenges that we'll have to see as to how things move forward. But on the whole, this solution then is a step forward towards a just and fair solution, but not an adequate approach. It is because it's not adequate because it is not really making a break from the hangover of the past. It is not really coming up with new principles and new ideas which are required in this modern world. And here I would again lastly touch upon where the world is moving. There is the taxation now globally is more and more identified on the basis of a fair tax policy. The concept of a fairness in taxation is something which was in fact alien a few years ago to most countries and to the judiciary in most countries. People remember this old statement of there is no equity about tax. But then things have completely changed now. There is now a complete unanimity that there must be equity in tax. There must be fairness in tax. The Pillar 1 reallocation of profits is a step forward towards bringing about that fairness in tax. The minimum tax of Pillar 2 is a step forward in trying to bring about that fairness in tax. But this has to go forward. In the ESG agenda, the environment, social and governance agenda, which is now going to be the next major disruption facing the world, it is already there amongst us. That agenda considers tax to be a fundamental driver of that agenda, and a driver being by ensuring a just and fair system all over the world, which countries will have to agree to. That's something which, therefore, we have to move forwards. We can't stop at this Pillar 1. Try and make the maximum possible gains from this solution, but then keep moving forward and try and still see that how best we can achieve a fair and sustainable tax system that all countries of the world can then justifiably say that this is a good system. This can lead to sustainable revenues in the long term, not just for the developed countries, but for all the countries. Rashmi made a very good point that there's no point now in trying to distinguish between residence and source countries. What must be done is to think about a fair system that compensates each country in the proper manner, whether it's a residence country or the source country. So that's where we are, ladies and gentlemen. I think, as I said, a good beginning, a good progress made by this inclusive framework in coming to this solution. Let's hope that a formalized solution does come out in October or shortly thereafter. But then still a long way to go, because this really may not be something which can ensure a just and fair tax environment. I think I'll just stop there for the time being. You're on mute, sir.
My apologies. Akhilesh, you are, as always, have been very erudite, very clear, and simplified the things, the present one and the future. I think nobody can, disagree with you that there is a need to move away from the concepts which have been driving international taxation till date, because there are so many things happening because of the development in technology, movement of fund, movement of people, all factors responsible for the growth of business are becoming very, very nimble. And that brings into light, the challenges which tax administration are facing. On the one hand, they have to protect the revenue, and at the other hand, they have to ensure that there is a growth of economic growth of international trade, because any multiple taxation will be a death knell in the growth of international trade, and that would be very harmful for the society as a whole. Thanks. Rashmin, will you like to just summarize the main points which have been highlighted by the three panelists?
Thank you, Mr. Singh. Many thanks to you. Before I try to summarize something, I convey my heartfelt thanks to Mr. Akhilesh Ranjan, Mr. Rajat Bansal, and Mr. Rasmi Ranjan Das. all three of them have brought out excellent issues on this digital taxation. And I also say one thing which I would like to repeat again and again, that our military defends our geographical boundaries, and our tax commissioners are defending India's revenue rights. So in my view, all the three panelists here are as important as army commanders. They are defending Indian economy. And many thanks to all of them. My personal thanks, and of course, if I may say so, on behalf of the Institute also, we thank all of them for sparing the time from their busy schedule and coming here. One issue I would like to say is, we are all on a journey to bring justness and fairness in international tax sharing system. It was not a just and fair system. Today is not the destination. Today we have not reached the destination. We will keep working on it, and we will optimistically keep working on it, that one day we will come to the destination. The most important things are two, that until the year 2013, India had no voice at all. We were not a member of OECD. OECD was not bound to listen to us, and they decided whatever they wanted. Now, from 13 to 2021, India was given an opportunity. I think probably they never, the G4, I call US, UK, France, and Germany as the G4 nations. Okay, they probably never anticipated that India will make such a solid contribution. We have made solid contribution. We have brought it to on the path of being just and fair, because accepting market as the third connecting factor, accepting country of markets right or jurisdiction to tax itself is a tremendous achievement. And thereafter, a lot of work needs to be done, and I'm pretty sure Indian Income Tax Department will continue to contribute the same thing. And probably I may share that we, the chartered accountants, tax professionals, will always be there to help the department in bringing about a better, just and fair system in taxation. I have a lot to say, but I will not say because we have already crossed 2 o'clock. So back to Mr. Singh, sir.
Thank you. Thank you. I totally agree with you, Rashmin, that it is not only the soldiers who are fighting at the front who protect our interest, but many people who are working in the country and trying to protect revenue, and doing every bit. And in that, I must say that the role of ICAI and the role of the chartered accountants is very, very important, because they are the first person or the first interaction of any business before the authority come into play. Definitely, all the three policy makers are contributing towards defending and towards ensuring that there is growth of trade, but equally important role has to be played by each and every chartered accountants. And I'm sure that it's not only the money or the profit will be driving force, but the love for the country. After saying this, I have the great honor of saying proposing the vote of thanks, and all of us have been talking about the contribution by the three panelists. So I restrict my vote of thanks to only two persons. Mr. Hegde, who has started the discussion, put the the ball rolling, and Rashmin Sangvi, who has been the actual pillar for this. I remember when I was posted in Mumbai as Director International Taxation, whenever we wanted to hear the other side, I always used to go to Rashmin for hearing what can be the other views. So the Rashmin continues in the same way, puts the different aspect to any issue on international taxation. It's always a joy listening to Rashmin. And of course, for the three panelists, no words will be sufficient to describe their knowledge, to describe their eagerness to share their experience, and the way they have explained. Any professor will feel very proud of the three gentlemen. With this, and last but not the least, my thanks to Mukta and her team, the Secretariat for Committee on International Taxation, who have been the backbone of all the webinars which we have been organizing, for the smooth flow, for the technical team which has been working and ensuring that there is no disruption. Thanks to all of them. With this, we bring curtain down to this webinar.
Thank you.
Thank you. Thank you very much. Very good.
Thank you.
Thank you very much.
Thank you.